If you and your spouse are getting close to retirement, taxes are likely one of your biggest uncertainties. It's not just about what you'll pay next year. It's also about how much control you'll have over taxes once your paychecks end. One type of retirement account often becomes more important after you retire than before. Starting in 2026, the rules for how much you can contribute to this account will change. For some couples, these changes open up new opportunities. For others, the changes can make things more complicated, especially if your income is still high in your last working years. Today, I'll explain what's changing, why it matters for people nearing retirement, and how this account can fit into your overall retirement and tax plan. Hi, I'm Snook Jin, a certified financial planner, and welcome to the Retirement Confidence Builder. I work with couples who are usually 5 to 10 years from retirement, and most have saved well. But now they want more clarity, especially about income, taxes, and flexibility in retirement. Let's start with the basics of this account and why it's often misunderstood. Next, we'll look at what's changing in 2026 and how these updates might affect couples who are still earning good incomes just before retirement. Many couples tell me something like this: we've done the saving part, but we're not sure how retirement will actually work. That uncertainty often centers on taxes. What will be taxable, what won't, and how much control will we really have year to year. This is where this type of account often matters more than people realize. The account we're talking about is a Roth IRA. You fund a Roth IRA with money that you've already paid taxes on. That means future qualified withdrawals are not taxed as an income. This is different from traditional retirement accounts. With those, you usually pay taxes on withdrawals later. For many retirees, this difference matters more than retirement than before. It can affect how much flexibility you have with income, it can affect taxes, and it can affect required minimum withdrawals. Retirees who feel confident don't try to guess future tax rates. Instead, they focus on spreading out their tax exposure. This usually means having some money that's taxable, some that's tax deferred, and some that's tax-free. That way, they can adjust withdrawals each year based on their needs. Roth accounts often help provide that flexibility. In 2026, the IRA contribution limits are higher than previous year. The standard IRA contribution limit will increase to $7,500. If you're 50 or older, the catch-up contribution will also increase. That means you can put in up to $8,600 total. For couples nearing retirement, this can make a real difference, especially if one or both spouses are still working, and especially if they want more tax flexibility in the future. However, the Roth IRAs have income limits. If you're married and filing jointly, you can make full contributions below if your modified adjusted gross income is less than $242,000. Above those levels, the amount you can contribute is reduced. This is where many high-earning couples nearing retirement get confused. Here are a few common questions couples ask. What if our income is too high right now, but will drop once we retire? Should we still be prioritizing Roth contributions this late? How does this fit with required minimum distributions later? Now, there's no one-size-fits-all answer, but these last working years often bring planning opportunities that you won't find after retirement. I recently worked with a couple who were about 4 years from retirement. They had saved a lot, but also all of it was in tax-deferred accounts. No one had explained how this could limit their options later. By adding Roth contributions during their last working years, along with other planning changes, they gained more flexibility in how they could set up their future income. It wasn't a drastic change, just more control and fewer surprises. If you're a few years from retirement, now is a good time to review how your accounts are set up. Not just how much you've saved, but also how those dollars might be taxed later. I've put together a short retirement confidence checkup. It helps couples evaluate income sources, tax exposure, and flexibility heading into retirement. Now, there's no pressure and no obligation. It's simply a structured way to see where things stand. You'll find the link below. Thanks for watching. I wish you the best on your retirement confidence journey.